This is Michael King. In this first video of 2 on financial forecasting, we're going to introduce the percentage of sales method. This method has 6 steps. We're going to provide an overview and cover the first 2 steps, deciding key assumptions and forecasting the income statement. Percentage of sales method, as the name suggests, involves making a forecast by first figuring out the growth of sales and then looking at other items as a percentage of sales, such as cost of goods sold or CAPEX. While this is covered in both Clear and Rakita, in Chapter 4, I'm going to be giving a slightly different exposition, which is supported by the Excel spreadsheet. The key to this forecast is going to be to understand what the external financial requirements are of a company, looking at how much debt or equity they may need to issue in order to have positive cash flow. In general, this kind of analysis is called Proforma Analysis, meaning we're making forecasts as if something was going to happen. We're going to have to generate the income statement, balance sheet, and statement of cash flows and make sure that they are all working together. Recall that retained earnings is the category that's going to tie the income statement to the balance sheet, because any retained earnings will increase common equity. We're going to look into how much cash is needed to run a business, where cash is going to be a plug that balances the balance sheet, making total assets equal to liabilities plus shareholders' equity. We're going to verify this plug by calculating the statement of cash flows, showing the breakdown of cash from operations, from investing, and from financing, to confirm that the plug is accurate. So by plug, I mean assets equals liabilities plus equity, and if you split up assets into all assets excluding cash plus cash equals to liabilities plus equity, what we're going to see is that we're going to forecast liabilities plus equity, where we know what assets excluding cash will be, and we simply are going to solve for what the cash balance will be. So the 6 steps are to set key assumptions. To start forecasting the income statement, we're going to be able to go as far as EBIT, which is earnings before interest and taxes, but then we're not going to be able to complete the income statement until we know the quantity of debt, because the quantity of debt is going to determine the interest expense. Once we have an assumption for debt, we're going to be able to make assumptions about working capital, meaning accounts payable, inventory, and accounts receivable. And with that, we're going to be able to start the balance sheet. There's going to be one item that we're not sure of, which is cash. So we're going to have to plug for cash and then confirm it using the statement of cash flows. Once we have that, all 3 statements completed, we're going to look at the financial ratios that we calculate, make sure they look reasonable, and check the sensitivity to the assumptions in our model. The key assumptions are going to be sales growth and profit margins. We'll illustrate this in a moment. We're also going to have to calculate what the cost of debt will be and the quantity of debt, which is going to be necessary to calculate interest expense, working capital items, the other current assets and current liabilities. We're going to need a tax rate and dividend payout ratio, and we're going to need depreciation and CAPEX. The easiest way to come up with assumptions or forecasts for these is simply to look at the average of these ratios for the past 3 to 5 years and see if there's a trend. Common size financial statements are very helpful for this, expressing all income statement items as a percentage of sales and all balance sheet items as either a percentage of sales or as a percentage of assets will make it easier for doing this calculation. So let's take a look at this example. This is a hypothetical example. Here we see the assumptions. We have assumptions under 3 categories: sales, growth, and margins, interest expense, taxes, and dividends, and productivity or working capital accounts. You can see that we're going to have sales growth starting in the first year of 10%, declining in a steady line to 2% by year 5. COGS is always going to be 70% of sales, and we could vary this, but for this purposes we're going to keep it flat. And SG&A here is going to be 10%. We need to have a number for depreciation and CAPEX, where depreciation reduces the value of assets and CAPEX increases it. It's typical that they don't equal each other, but by the end of our forecast horizon, we should set them equal to each other. Here, depreciation is steady at 5%, CAPEX is at 10 and declines steadily until 5. For the debt, we need to know the cost of debt. We're going to also have a tax rate and dividend payout ratio, and we're going to be using these different days of receivables, inventory, and payables to calculate working capital. We forecast the income statement based on these sales and growth assumptions. Here we can see that revenue, assuming it starts at 100 million, goes up by 10% in year 1 to 110, and then 8%, 6%, 4%, always increasing but at a slower rate, until by year 5, revenue is 133.6 million. Because COGS, SG&A, and depreciation are all a percentage of sales, you can see that it's just a question of multiplying the sales figure or the revenue figure by the percent. And you can see that it's very easy to calculate what the operating profit or earnings before interest and taxes will be. At this point, we can't go any further until we have an assumption about interest expense, where interest expense is going to be determined based on the cost of debt and the quantity of debt. So once we make an assumption about these two, we'll be able to calculate interest expense. The simplest assumption is just to build a debt schedule where you start by assuming no change in the quantity of debt. You build your financial statements based on that assumption, and then later, if it looks like cash flow is going to be too low, we can build in an increase in debt as well as interest expense and iterate until we find the correct quantity. Obviously, there's a circularity when you build this kind of pro forma forecast, because you can't know what your cash is going to be until you know what your debt and your interest expense are. You need the quantity of debt to get interest expense. The interest expense will determine your cash balance, because interest expense is the use of cash. And then, if you need to, you increase debt if the cash balance gets too low, and you reiterate. So let's just assume in this case the cost of debt is 6% and the company starts with 100 million of debt. That means that interest expense is going to be 6 million, and if there's no change in either of those variables, we can see that it will be 6 million each year. Now, with that, as well as an assumption about the tax rate, we can get to net income, and we have an assumption about the dividend payout ratio. Here it's 12%. You can figure out how much is paid out as a dividend to common, and then what is left over as retained earnings. That's part 1. See you for part 2.